Good afternoon. My name is Jordan Rose, and I'm a tax director and head of estate and trust planning here at Belton Lyons and Schuman. Today, I'd like to talk to you about the need for estate planning. Several years ago, I wrote an article entitled, "Why Taxpayers Are Wrongfully Rethinking the Need for Estate Planning." And this is because a few years ago, Congress increased the estate exclusion amount from $5 million to $10 million, and it's indexed for inflation. Today in 2020, that exclusion is over $11.5 million per person. So fewer people are now subject to the federal estate tax since the exemption is so high. In addition, many states follow the federal rules or they don't have an estate tax at all. So that also eliminates the state estate tax. However, as you can see on the slide, non-taxable estates today may become taxable in the future. Why? Well, first, assets grow, a rise in value of the real estate or in the stock market. Also, laws change. Congress they raise the estate exclusion, they can lower the estate exclusion. And as I like to quip, some people actually win the lottery. And basically, as time passes and life events occur, such as marriage, divorce, death, and as families grow larger and smaller, most estate plans become hopelessly out of date. I hear a lot of excuses as to why people don't do estate planning. First, they say, well, if there's no tax due, what's the need for estate planning? Well, that's the way it might be today, but who knows? Congress may lower the exclusion from $11.5 million down to maybe $3 or $4 million, and there will be a need to do estate planning. They say I'm too young. I really don't buy that. I think that all young people, once they reach age 18, should have some sort of an estate plan, especially when you get married. Maybe a simple 3-page document, but still you have something, especially when you start raising a family and have children. Another excuse is all my property is held jointly with my spouse. Jointly held property is good in a lot of situations, but it can also ruin a great estate plan. Estate plan is only for rich folks. Well, that's not necessarily true. Look at it this way. If the Rockefellers lost $5 million, or if Bill Gates lost $5 million, that would be chump change to him. But what about if you lost $5 million? So protection of your assets is vitally important. It's too expensive, I hear. Well, don't look at it as a cost. Look at it as what is the value of that estate plan. What will it save your heirs when you pass? I also hear we had our wills drawn up when we were first married. It's probably 15, 20, or even 30 years ago. Things change, families grow, families contract, things have changed. And finally, the excuse that I hear is, I don't want to think about it. What is it? Of course, death. So let's look at some reasons why estate planning is so important, even for the modest estate owner. First of all, even though there may not be a federal estate tax, several states have estate tax exclusions that are well below the federal level. Several states, such as Pennsylvania, impose an inheritance tax. And for using Pennsylvania as an example, Pennsylvania's inheritance tax ranges from 4.5% all the way up to 15%. So even though there may not be a federal estate tax, your heirs will be surprised if they have to pay 15% inheritance tax to the Commonwealth of Pennsylvania. You need to provide for a surviving spouse. That's always an important reason to do a estate plan. You also might have a special needs family member that you want to provide for, also safeguarding that if you leave them assets that are not in a special needs trust, you may jeopardize federal and state aid that they're currently receiving. You also want to plan for the care of minor children. Another reason for estate planning is you might be on a second and today even a third or fourth marriage. So you want to provide for your current spouse, but when they pass, what about children that you might have from a prior marriage? You also want to make sure that you're providing for them. Basic asset protection is always a reason to do estate planning. You want to make sure that your surviving spouse, the assets that you leave to them, are protected from predators or from themselves. And some may not be able to manage funds or have spendthrift problems. divorce planning is another reason that estate planning is needed. Maybe your family has a closely held business, and let's say you have 3 children, 2 of them are well involved in the business, but the third is off doing something else. And the value of the business is the bulk of your estate. How do you provide for that one child that is not involved in the business in a fair manner, since you're probably leaving the family business, which is the bulk of your estate, to the other 2 children? You may want to provide for the future education needs of your children or even your grandchildren. Charitable intent is another reason why estate planning is very important. At death, you can create a donor advised fund, a charitable remainder trust, or maybe even leave assets outright to charities or fields of interest of your choice. Family dynamics are also another reason for the need for estate planning. We talked about your divorce, but what about if your kid is married or dating someone that you really don't like and you really don't think that marriage is going to last? You want to protect your assets. Also, what about if you have a family member that has a drug or alcohol problem? The question I always get is, should I be leaving assets to this child? And if so, how can I do it in a safe manner that they won't take all those assets and the money that we leave them just and pursue their addiction? Valuation issues are another reason to do estate planning. Assets such as antiques, coins, artwork, some sorts of real estate, hard to value assets, that you want to take care of these assets and maybe freeze the value today so it doesn't become an issue at your death. Disposition of tangible personal property, books, coin collections, clothing, furniture. Who are you leaving it to? A lot of family arguments come up over who gets what from mom and dad's estate. Basically, good estate planning allows you to dictate how you want to dispose of your assets. And believe it or not, there's also planning for pets. And we're not going to get into it, but there's a whole niche area in estate planning for pets. So let's move on to some basic estate planning concepts. As I mentioned before, each individual can exclude over $11.5 million from their taxable estate. That's over $23 million for a married couple. And this credit is applied against lifetime gifts when you make gifts over the annual exclusion amount, or you can use it at death, as I like to call it, a use it now or use it later concept. I'm going to talk about 2 planning opportunities within estate planning. And the first one that I want to spend some time on is the portability election. This is also known as the deceased spousal unused exclusion amount. In many cases, when we did conventional estate planning, we try to balance the assets evenly between the 2 spouses. Why? Because we didn't know which spouse was going to die first, and we wanted to make sure we used up that spouse's total estate exclusion amount. But we didn't know who was going to die first, so we try to balance out the assets as best as possible. In 2010, Congress passed a rule called the portability election. Coincidentally, it's Section 2010 of the Internal Revenue Code. And this allows one spouse who dies and hasn't used their entire estate tax exclusion to port it over and to move it over to the surviving spouse. And the surviving spouse would add that to their own exclusion amount. So really, in this case, it doesn't make a difference who dies first and which assets they own, because any unused estate exclusion amount can just be ported over and added to the surviving spouse's amount. Thus, the assets that are ported over and passed to the surviving spouse would be included in that surviving spouse's taxable estate. But the good thing is, first, they have the additional exclusion, so they wouldn't pay federal estate tax on them. And the second thing is, there's a second bite of the apple. When that surviving spouse dies, the assets that are included in his or her estate are going to get a second step up in basis. So there was a step up in basis. When the first spouse dies, the assets get passed to the surviving spouse, and at their death, there's a second step up in basis. And we're going to see why that's so important in a few slides. In order to elect portability, the executor needs to file an estate tax return. That's Form 706. Now, normally, small estates under the exclusion amount don't have to file an estate tax return. However, if you want to elect portability, you need to file the Form 706 to make the election for portability, even though you otherwise would not have to file an estate tax return. So how do we make the election? The portability election is not an affirmative election. There's no check in the box. All you really need to do is to file the Form 706 and fill out the schedule, which calculates the amount of the unused estate exclusion that you're porting over to the surviving spouse. And there's some special rules, we just don't have time to get into it, when dealing with non-resident surviving spouses and a qualified domestic trust, which is used for the benefit of a non-US citizen surviving spouse. You want to make sure if you have this situation that you seek the counsel of an estate attorney or CPA that's knowledgeable in this area. The election is effective as of the date of death, and it's irrevocable as of the due date of the 706. But the next bullet point is very important, and that's the statute of limitations. Normally, the statute of limitations after a return is filed is generally 3 years from the date it is filed. However, the statute of limitations is extended in the case of a portability election and does not expire until the statute of limitations of the surviving spouse's estate has ended. And that could be 20, 30, or even 35 years after the first spouse dies. So you want to make sure that all the paperwork and a copy of the 706 that was filed to elect portability when the first spouse dies is kept in a safe place, because it may be several decades, but the IRS can ask to examine it to make sure that the correct amount was ported over to the surviving spouse. Now, I spoke about electing portability. Do you have to elect portability? Absolutely not. So how do we opt out of portability? Well, it's very easy. If we have a small estate under the $11.5 million that otherwise isn't required to file a return, you simply don't file the return. Remember, we filed the 706 to elect portability. By not filing the return, we haven't elected portability. If a return is otherwise required to be filed because the estate exceeds the exclusion amount and you have to file a Form 706, that is, by filing the 706, we've elected portability. But if you have to file a 706, there's a box you can check to opt out of portability. So the question is, why would I want to opt out of portability? You probably don't want to opt out. And what's the reason for that? Well, the hazard of not electing portability is that the assets could grow or the law could change between the death of the first spouse and the second spouse. And at the death of the second spouse, if you haven't elected portability from the first spouse's estate, you could find that the second spouse has a taxable estate, and you could have avoided that by electing portability at the first spouse's death. Let's talk a little bit about estate tax and income tax planning. We've talked about the estate side of things. So let's go over a few parameters here. The highest estate tax rate is 40%. The highest marginal personal income tax rate is 37%. Plus there's a 3.8% surtax, that's the net investment income tax. And there's also state income taxes. So now we have a reference point. Since most taxpayers won't be subject to the estate tax, the focus now moves from estate tax to income tax. So we want to properly plan which assets are best to pass to our beneficiaries and what aren't really good assets to pass to beneficiaries that we might want to do some preemptive planning for. So the planning has to be on an asset by asset basis. I use the word basis. Basis planning is the new norm. because if you've elected portability, you get that second step up in basis, which is very important. I'll come back to that in a moment. But basis planning is very important. And the best assets to have in your state to pass to a beneficiary are items that will not cause the beneficiaries to have an income tax liability. Remember, we don't have an estate tax liability anymore, so the focus moves on the income tax liability that the beneficiaries will have when they inherit these assets from you. So good assets to leave to your beneficiaries are Roth IRAs, because they're tax-free, and tax-exempt bonds, since the interest on tax-exempt bonds is just that, tax-exempt. An example of the worst asset that you can leave to your heirs is a traditional IRA. Why? First, an IRA does not get a step up in basis. It's considered income with respect to a decedent. Secondly, when your heirs inherit the IRA, they have to start taking distributions from that IRA. And if they're in a high income tax bracket, they're going to be paying a lot of tax on those distributions. So we need to consider the tax implications to the beneficiaries. This is the income tax considerations. And that may drive which assets you want to spend down first, because if you spend the right assets down first, that would cause the most liability to your heirs. What you're leaving them are the best assets that will trigger the least amount of income tax when they inherit those assets. So let's just take a quick review. What are the advantages of this portability election? As I mentioned several times, you get a second basis step up at the surviving spouse's death. And this creates the ultimate federal and state capital gains tax savings, because if they sell the assets right after the second death, there probably won't be any capital gains tax. There's lower administration expenses because the assets in essence have moved directly to the surviving spouse, not into a credit shelter trust or any other type of trust for which you probably will have to pay to have an income tax return prepared every year. So there's less administrative expenses on an ongoing basis by electing portability. It allows for spousal rollovers of IRAs and retirement plan assets. And the surviving spouse has more control, or what we call a general power of appointment, over these assets, because they own the assets. They now control how those assets are to be used during their lifetime and beyond. There's also income tax considerations. The income from the assets that are ported over to the surviving spouse and now become part of the surviving spouse's estate will be tax subject to individual income tax brackets, rather than if they had been left to a credit shelter trust, they'd be subject to the condensed trust tax brackets. For example, the trust pays the highest rate of 37% when taxable income is over $12,700, where it would take several $100,000 of taxable income before the surviving spouse would be in that top bracket. And it could also save or even avoid the net investment income tax for the same reason, because trusts are subject to that net investment income tax at a much lower threshold than individuals. But what are the advantages? Now, again, we're comparing and contrasting the new portability election to the conventional credit shelter trust. There are some advantages, though, to the credit shelter trust. One, there's asset protection. Assets that are placed into the credit shelter trust are protected from creditors, whereas if we simply made the portability election, those assets are now in the hands of the surviving spouse and subject to the surviving spouse's creditors. The appreciation of the assets that are placed in a credit shelter trust are exempt from the surviving spouse's estate. But then again, there's no step up when those assets come out of the credit shelter trust at the second spouse's death and go to the kids or grandkids who are the ultimate beneficiaries. And there's also some generation skipping transfer tax protection when the assets are placed in a credit shelter trust. So the moral of the story is, when you do this planning, you want to speak to your tax advisor, whether it be your estate attorney or CPA, about whether or not you want to plan for a portability election or a credit shelter trust, or maybe a combination of both. Finally, what I'd like to remind people is that we've talked about the federal estate tax. There's also state death taxes that need to be considered. And this is many times forgotten. The DSU, or the portability concept, is a federal concept. Most states haven't yet adopted the portability election statute. However, just very recently, in 2020, Maryland has adopted, and is one of the first states to adopt a portability election. So several states are now coming around to the federal portability election. So depending on what state you live in, it may or may not apply to you. So if the portability election doesn't apply to your state, you may need to be creative in these situations, especially where the estate exclusion is less than the federal amount. In these cases, you might want to consider a credit shelter, or we sometimes call it bypass trust, to protect the assets up to the state exclusion, and then make the portability election for the assets on a federal level beyond that amount. And one other concept is the use of a marital trust, leaving assets to a marital trust for the benefit of the surviving spouse, followed by the surviving spouse making a gift of those assets to the children, to children's trust out of the surviving spouse's trust. And it could have limited benefits in some states, such as Connecticut and Pennsylvania. Connecticut does have a gift tax regime. It's the only state that has a gift tax regime. And states like Pennsylvania that have a clawback provision where gifts made within 1 year of death are brought back in to the decedent's estate for state inheritance tax purposes. And the list just goes on and on. Again, the moral of the story is estate planning is very important for all the reasons that I've mentioned to you, and there are ways to protect your assets after you've died, but you have to do the planning now. Again, if you have any questions, we at Belfin Lyons and Schumann are prepared to meet with you. If you have any questions, please call one of our associates or partners, and we'd be happy to arrange a meeting. In the meantime, stay safe and have a great day.